This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril in Singapore. The top stories this hour. Asia set to extend a global sell-off in stocks and bonds as President Trump heads to Davos, renewing his Greenland push despite growing resistance in Europe. Gold at a fresh record while volatility soars. Japan calling for calm amid a rout in government bonds while the Prime Minister's election pitch to cut food taxes spooking investors. We'll hear from Finance Minister Satsuki Katayama. And much more coming up from Davos, including conversations with the CEOs of UBS, Deepmind and Anthropic. But first, here's a look at how U.S. assets fared overnight. We saw the selling across stocks, bonds, FX as well. The worries that Trump's Greenland ambitions with Davos underway could actually lead to somehow an all-out trade war. And certainly, you're seeing those tariff risks playing out among U.S. assets, the worry that they dent the appeal. It's worth noting that we are coming off a month, the past month, where volatility across assets has been low. So take that into consideration as we see these steep moves. Lots of superlatives out there. When you look at U.S. stocks, for Wall Street, it was the worst session since April last year. And in terms of the move in treasuries, certainly the calm there was shattered. And you saw that 30-year yield move intraday. It popped above 4.9%, by the way. So this was to the highest level since early September. So that breakout you're seeing in yields. Shery?
And Avril, really, the global sell-off was first triggered here in Japan, right? And based on purely domestic reasons, we're talking about the upcoming election in February 8th. And what will that mean for more spending in this country? So we saw JGB yields really skyrocketing, what we're calling the superlative here, the JGB bond market meltdown. But take a look at Nikkei futures, not doing much after 4 sessions of losses already. The Japanese yen holding steady at that 158 level. We're watching the ASX 200 downside of 0.4% early in the trading session. We're also watching New Zealand because we are expecting an election date to be announced by the Prime Minister there. But talking about the elections is really what's happening here in Japan, because that promise coming from Prime Minister Takaichi about those temporary tax cuts on food, that could actually amount to $32 billion of spending per year. And people are wondering, how will that be funded? So there's again that narrative of, are we seeing the Japanese least trust moment? Remember back in 2022, that vicious sell-off in UK gilts, and really all to do with trying to pass these package of spending tax cuts that have been unfunded. But take a listen to what Japan's finance minister had to say, telling investors to calm down. Speaking to us in Davos, Satsuki Katayama defending the government's fiscal policies as responsible and sustainable.
I don't have any concerns about the absorption of JGBs going forward because we have a well-thought-out plan for JGB issuances. I believe the Ministry of Finance of Japan is perhaps the best Ministry of Finance in the world in terms of our close communication and careful communications with the market participants.
Investors obviously disagree with the perception that you hold right now. They say that JGBs are not the ones to buy at this point in time. There are huge concerns about your finances. How do you respond to that when they say that perhaps Japan's bond market is a canary in a coal mine?
I think those concerns are misplaced. We put a lot of importance on sustainability of our public finance. If you look at the draft budget for all this year, for the first time in 28 years, we will be achieving a primary balance surplus. If you look at our economic policies, through our economic policies, the plan is to expand the size of the Japanese economy. We have already seen an increase of tax revenue by 84 trillion yen, and we are to spend without additional borrowings. And as if you could look at our dependency on JGBs, the public debt dependency is at a 30-year low. As the Minister of Finance, I am not going to ignore the concerns in the market. The Prime Minister has been talking for the past couple days about an election to ask for the confidence of the public. She has talked about a possible plan for reducing the consumption tax rate. I know that is one of the reasons why the market has become rather nervous. But she has said that Japan is not going to depend on issuance of deficit-covering bonds. Since October of last year, we have taken a very responsible approach to public finance, talking about responsible, sustainable, and proactive fiscal policies. We are not taking expansionary fiscal policies. And this is demonstrated by some of the numbers that we see. So I asked the market participants to calm down.
Japanese Finance Minister Satsuki Katayama speaking with Bloomberg's host Linda Amin in Davos. There is a lot to unpack when it comes to these market moves. Joining us now is Rick Gardner, CIO at RGA Investments. Rick, good to see you. First off, let's talk about Japan. Did it surprise you in any way, the way in which it was so sudden and steep, the selling in JGBs?
Well, I think it could be a surprise, but I also have to say the markets are having less of an appetite for tax reductions without a clear understanding of where funding is going to be coming from with those tax reductions. So the type of sell-off that we saw, although Japan has generally been viewed as somewhat of a safety trade, when you see something like this, I think it does give everybody pause. You couple that with the beginning of the morning with a weak bond auction. We see yield spike, and then there was contagion there that kind of spread across the entire bond market.
Yeah, you talk about this contagion. To what extent should we be worried about further spillover to global debt at the time where we have Danish pension fund talking about how they're going to exit U.S. treasuries, perhaps as a way in retaliation for what we're seeing Trump's moves over Greenland?
Yeah, global contagion is something that we want to keep an eye on, but I do think you have to look at every country based on its own merits, and you want to be careful about just assuming that this would spread too rapidly. But I do think it's fair to look at it as potentially a risk-off sentiment that maybe starts to enter our markets. You know, January tends to be a really important month because it kind of gives us an idea of what the rest of the year may look like. So I guess as we're looking at it right now, maybe it's not a surprise. I'm expecting volatility this year, but I will say I do expect things to, as a general trend, be positive, particularly here in the United States markets.
Yeah, tell us a little bit about the merits of the United States, because what we're seeing right now is that South America trade really regained momentum. And it's not just because of the concerns around Greenland. It's just this uncertainty and anxiety that the Trump administration causes, whether it's with the leader in Venezuela, more tariffs on Europe, and of course, the constant attacks on the Federal Reserve.
Well, it does seem like we've hit the rewind button coming up with tariffs, again, as an obstacle for the markets. And I think if you think about what this administration has done in the past, it's particularly when it comes to the tariffs, now that is the tool that the president is using here for Greenland. I think it's fair to say the administration's use of tariffs has more been about trying to get a deal than trying to dominate. And so I think if you're an investor and you can kind of take a step back and look at how the tariff negotiations of last year played out and the trade deals that came in response to it, I think that might give you a fresh perspective on what's happening with Greenland and these tariffs. I will say, though, escalating tariffs are definitely an issue that we have to be very cognizant of because escalating tariffs are what can really cause a lot of uncertainty and damage to the overall economy.
And we have seen investors really hang into that narrative and continue to send the U.S. markets higher based on the fact that we have most of the time seen President Trump perhaps backing down, or what other people have called the taco trade. But what when you factor in the valuation issue, how much all of these AI stocks have been pushed up?
Sure. I think that AI valuation is one that everybody should be watching very carefully right now. And to your point, I want to make sure I go back to that. The taco trade, I know that's a euphemism that gets thrown around a lot. I think the president has been pretty clear about what his goal is in Greenland as far as the Golden Dome defense system and what they're trying to put together there. And so Greenland is kind of the tip of the spear. It's the first area where if missiles were coming towards the United States, that would be where we would notice them first or recognize them. Our systems would hopefully recognize them first. Alaska would kind of be the second shot of that, and then you've got the U.S. systems here. So when you kind of step back and look at the ambitions they have for the Golden Dome as a defense measure and how critical Greenland is to that, I think it's reasonable to think that they're probably looking for a deal, maybe something similar to what we have in Guantanamo Bay, a perpetual lease where it allows us to be in control of that area and make sure it's something that we can use for our defense system, but not something that we're trying to do a hostile takeover. And that has tended to be kind of this administration's methodology when it comes to negotiations, is they start way, way, way over to one side of an argument, and then we end up coming back to a deal somewhere down the road. So as an investor, at this point, I could be proven wrong, but at this point, I'm looking for something to show that that's not the course of action here.
Rick Gardner, really good to get your insights. CIO at RGA Investments. We'll be delving into a little bit more about the geopolitics of things as we've been discussing, because President Trump's economic advisors are now downplaying the risk of a U.S. invasion of Greenland at the World Economic Forum in Davos. This comes as Trump pledges to move forward with the idea of acquiring the territory, which is, as we mentioned, currently under Danish control. Let's bring in Bloomberg senior editor Derek Wallbank. Derek, so what are we expecting out of Davos?
Well, Shery, all eyes are going to be on Donald Trump when he arrives at Davos. He's going to make a speech there. He's going to meet with some business leaders. And, he's not even left the United States yet, but he is already the talk of the influential global gathering right now. I mean, I think every single thing is to do with Donald Trump right now, is to do specifically with this Greenland threat. But that's sort of the start point for talking about all of the other ways that he, in his first calendar year back as president, has upended the system of global trade. Now, you did see advisors, top officials from the United States sort of, and Scott Bessent is never going to say taco anything, let's be clear, but Bessent was saying, look, his quote, sit back, take a deep breath, do not retaliate, have an open mind, right? That's what Bessent is talking about. Jameson Greer suggesting that it's possible that Trump is setting the scenes for negotiations over Greenland, that and kind of that there's something here to negotiate, right? And so that's kind of the vibe that you're getting there. I do think that U.S. officials are noting the European pushback that's going on there. You're certainly seeing an increased level of seriousness from the Europeans, and I look at this particularly in terms of the idea of what's being talked about, right? The prior guest mentioned that Trump likes to talk about sometimes the extremes to then move into a more sort of measured final outcome. You're seeing the Europeans start to do this as well. Make no mistake, the idea that Europe might start dumping treasuries, and European countries hold about 40% of foreign U.S. treasuries here, so it's not an insubstantial amount. But the idea that Europe might start taking some financial penalty and try and use markets against the United States, that's not just idle talk. That's really trying to send a message to the White House.
Derek, you raised an interesting point about maybe Bessent trying to tone down and saying, it's not about an invasion per se, calm things down a bit. Equally, is there a bit of a difference in the way that Trump is viewing these several European countries in the way in which France has been singled out?
Yeah, I think I'm interested to see what actually happens here, right? I'm mindful of the idea that we've still got these Iran trading tariffs that the White House was talking about. We haven't seen meat put onto the bones of that, and we haven't seen what's going to happen there. We've got this sort of threat as well against some of the European nations that rallied towards Denmark. Trump singled out France and mentioned something about a potential even 200% tariff on champagne campaign, which would be a sort of disassociative tariff that sort of breaks that relationship, because that's just really too high to bear in a lot of ways. So there are these sort of threats looming, but we've seen a lot of those threats. I'm genuinely waiting for the paperwork on some of these things, right? Because the paperwork that the White House issues does not always line up with the threats that are put out on Truth Social, and it's so important in these things to see what that paperwork actually looks like, because let's be clear, both sides can kind of move the op-ed window and say, here's what we could do, here's what we could do. It really matters what they're actually going to do. And right now, the message that we're getting a day before Donald Trump gets to Davos is the message from U.S. advisors of let's take this down a notch.
Derek, thank you very much for walking us through all of this. Bloomberg senior editor Derek Wallbank. Now, coming up on the Asia Trade, Arbroath Group and EFG Asset Management join us to talk market strategy as the new year calm for investors is shattered. Plus, more on the geopolitical tensions driving renewed volatility with the Council on Foreign Relations. Much more ahead. This is Bloomberg.
We could be setting up for another risk-off session across Asia. Already, the ASX 200 is leading us lower, down 0.3%. Nikkei futures, though, rebounding up 0.2% after 4 days of a sell-off in Japanese stocks. U.S. futures also pointing to the upside of 0.2% after the sell-off that we saw in the Wall Street session, coming back from a holiday in the S&P 500, falling more than 2%. Of course, a lot to do with the geopolitics and President Trump's ambitions over Greenland and perhaps more tariffs when it comes to Europe. Let's get more perspective on how geopolitics is impacting global markets and the economy as well. Joining us now is Christopher Smart, managing partner at Arbroath Group. He previously served as special assistant to President Obama at the National Economic Council and National Security Council. Chris, always good to have you with us, especially on a day like today where we're seeing a lot of excitement, anxiety over the markets, perhaps a global economy as well. Why all of a sudden? So far, when it came to geopolitical friction, investors seem to brush it off, and even the global economy is standing quite strong.
Well, good to be with you both. I think it is a busy news cycle, obviously, and there are a lot of moving parts that I think investors are trying to track and then help price into what's going on. And I think you're probably seeing a reaction to both that as well as, what we've all seen and worried about as, slightly rich valuations. And so there has been a time and a moment for some of this adjustment. To be honest, I'm not sure that this sell-off, even if it continues for a few days, is the big story. I think we're going into what is likely to be a fairly optimistic earnings season. We're moving into a U.S. economy that's likely to grow maybe 2.5% this year, maybe a little more. The IMF has just upgraded global growth projections for this year, and you've got inflation coming down as well as a lot of tax benefits flowing through to the U.S. consumer. So I'm not sure this sell-off is as big a story as the underlying geopolitical tensions that you're asking about. And to me, what the big news is around Greenland is that the president has essentially said he doesn't trust NATO to defend the United States anymore. And that is something that is even bigger than he has been talking about in terms of Europeans need to spend more money or we need to settle something between the Russians and the Ukrainians. This is really fundamentally saying that the U.S. doesn't really trust its allies. And however it works out a deal around access to Greenland, that I think is the underlying rift that investors are going to have to start pricing in over a longer term. What is going to happen to investment flows back and forth across the Atlantic? What is going to happen to trade flows? And in a crisis, who is going to be there to backstop markets if you can't really count on the U.S. to do that?
You actually see this going past 3 years of the remaining Trump administration because you're talking about a fundamental shift in the way that America views its allies in Europe.
Well, it's not so much how America views allies in Europe anymore as much as how Europeans view America. I don't think it's going to be difficult. I don't think it's going to be easy for any president after President Trump to come back to Europeans and say, no, trust us, we're with you, because they know we've elected a candidate like this twice, and they're not going to be sure who's going to follow. And they're going to see that this alliance, this relationship that's built up and been quite successful for 75 years, we have to remember, is facing some real trust issues that, Europeans are going to wonder, are the Americans going to be there to defend us? Europe's adversaries are going to look and say, well, maybe we don't really have to worry about Europe and the U.S. standing together anymore, because there's daylight between them and we can separate them. Again, not just on military issues, although those are the important fundamental ones, but on issues of trade, for example. If we're trying to present a common front to China on its trade surplus, that's going to be a much harder negotiation than it was even a week or two ago.
Christopher, you were formerly a special assistant at the NEC in the Obama administration, I believe. Talk to us about how much more difficult this all perhaps makes telegraphing or projecting what Trump's plan is for the NEC, given how the uncertainty over policy has evolved.
Well, I think, this is a very different White House from the Obama White House or any previous White House, in the sense of how advisors influence the president, how he makes his decisions, how the different interests of different parts of the government are brought to bear for a decision at the presidential level. I think what you're seeing right now, as your reporter mentioned earlier, the president is going off ahead on this with his opening outrageous bid with the Europeans, and it's up to his advisors right now to try and dial back some of the emotion in the room without contradicting him. But the one decision maker who makes any difference at all in this White House is the president himself, and it's not really clear how much his advisors can help shape what is going to be the final deal that he's ready to accept with regard to Greenland. He may not know himself what that looks like until he sees what room for maneuver he has, what the market reaction is, whether he thinks the U.S. economy can withstand that market reaction, and where the conversation heads.
Christopher, just quickly, if we can, on the market reaction, do you perhaps see a chance that, given how yields have trended higher, that affects borrowing costs in a year where affordability is such a big issue of midterm elections?
I think so, but I think, again, the borrowing costs that you're seeing today are going to turn back to the fundamentals in the economy. And as inflation comes down and we expect Fed to cut rates at least a little bit more, maybe not as much as the president wants, but a little bit more, I think those will come back into realignment. I think the issue with these geopolitical tensions we're talking about is they build up over time and start amping up the risk premium over a series of months and years rather than weeks and days.
They translate into longer-term issues. Christopher, great to get your analysis. Thank you so much for taking the time. Christopher Smart is managing partner at Arbroath Group. More ahead on the Asia trade. This is Bloom. Some deal-making activity to get you up to speed with, and this is in relation to a push by the US and Australia, other countries as well, to secure supplies of rare earth minerals. This one in relation to US Miner Energy Fuels agreeing to buy Australian Strategic Materials is an all-stock deal valuing the firm at almost $300 million. You're seeing the market reaction in the surge in the shares of ASM. This is Bloomberg. Let's take a look at Netflix shares after hours slipping there after the streaming giant posted stronger than expected fourth quarter earnings. The company is warning of rising content costs and issued a cautious forecast for the months ahead. Let's bring in Bloomberg's Chris Palmieri, who leads our media and entertainment coverage. So, Chris, talk us through the results first and the forecast and how maybe all of this has been overshadowed by the potential Warner Brothers deal.
Yeah, so as you said, pretty good numbers this past quarter, higher profits and sales, and big jump in subscribers, so 24 million more subscribers year over year globally, really growth all over the world, including in Asia. So that was good. They did give some guidance for the current quarter, the first quarter, that were disappointing in terms of where the street is. They've talked about a few things. One is the cost of this pending merger with Warner Brothers. They said it's going to be about $275 million in expenses. That's on top of about $60 million they spent last year. And they are increasing their content spending 10%, which is a big number when they're already at $18 billion. So lots more TV shows, including all around the world.
Tell us a little bit more about how the deal was amended, because it's supposed to fend off Paramount, right? That's claiming that its cash tender offer is actually superior.
Right. So Warner Brothers and Netflix announced the deal last month for $27.75 a share. About 80% of that was going to be in cash and the rest in Netflix stock. Netflix stock has not done well since the news of their pursuit of Warner Brothers. And one of the things Paramount's been hammering them on is that investors would get lower value because of the decline in Netflix shares. So today's news, as we have reported they would last week, Netflix made their bid all cash. So again, more in line with the all cash offer from Paramount.
Yeah, on that note, Chris, we are also hearing from the Netflix CEO sounding confident of this deal going through. Take a listen.
We've already made progress towards securing the necessary regulatory approvals. We submitted our HSR filing. We're working closely with WBD and the regulatory authorities, including the U.S. Department of Justice and the European Commissions. We're confident we're going to be able to secure all the approvals because this deal is pro-consumer, it is pro-innovation, it's pro-worker, it is pro-creator, and it is pro-growth.
Chris, when you hear something like that, I wonder what Paramount is thinking in terms of the offense it needs to put forward.
Well, they've been actively trying to thwart this deal, talking to shareholders, talking to regulators. We saw over the weekend the chief legal officer at Paramount put out a LinkedIn post where he likened Netflix to John D. Rockefeller and a sort of trust that needed breaking up. And so big effort on Paramount's part to torpedo this deal.
Bloomberg's Chris Palmieri, who leads our media and entertainment coverage there with the latest on that Netflix deal. Take a look at how we're setting up for the Japanese market opens in less than half an hour, because it's all to do with the JGB space, isn't it? I mean, the Japanese yen is holding steady. 158 is the level. Nikkei futures now pointing to the downside of more than 1% already. We had seen 4 sessions of losses, the worst in a couple of months already for the Japanese equity markets, but all really starting with the domestic issues here in Japan and anxiety from investors coming that could we see a Japanese Liz Truss moment, a vicious sell-off when it comes to the bond space here in Japan. Already sent the 40-year rate to the highest level since 2007, and in fact topping 4%, which is a first for any maturity in JGBs. A lot to do with how they're going to fund this promised temporary tax cut on food, and perhaps a fiscal responsibility issue, of course, for the Takaichi government. Speaking to us in Davos, Japan's finance minister Satsuki Katayama, though, defended the government's policies as responsible and sustainable.
I don't have any concerns about the absorption of JGBs going forward because we have a well-thought-out plan for JGB issuances. I believe the Ministry of Finance of Japan is perhaps the best Ministry of Finance in the world in terms of our close communication and careful communications with the market participants.
Investors obviously disagree with the perception that you hold right now. They say that JGBs are not the ones to buy at this point in time. There are huge concerns about your finances. How do you respond to that when they say that perhaps Japan's bond market is a canary in a coal mine?
I think those concerns are misplaced. We put a lot of importance on sustainability of our public finance. If you look at the draft budget for all this year, for the first time in 28 years, we will be achieving a primary balance surplus. If you look at our economic policies, through our economic policies, the plan is to expand the size of the Japanese economy. We have already seen an increase of tax revenue by 84 trillion yen, and we are to spend without additional borrowings. And as if you could look at our dependency on JGBs, the public debt dependency is at a 30-year low. As the Minister of Finance, I am not going to ignore the concerns in the market. The Prime Minister has been talking for the past couple days about an election to ask for the confidence of the public. She has talked about a possible plan for reducing the consumption tax rate. I know that is one of the reasons why the market has become rather nervous. But she has said that Japan is not going to depend on issuance of deficit-covering bonds. Since October of last year, we have taken a very responsible approach to public finance, talking about responsible, sustainable, and proactive fiscal policies. We are not taking expansionary fiscal policies. And this is demonstrated by some of the numbers that we see. So I ask the market participants to calm down.
What concrete steps will you take to fund all the spending plans? There have already been massive, significant stimulus, and now the Prime Minister has said she's cutting the consumption tax, which amounts to 8%. That leaves a huge hole, I suppose, in revenue.
The Prime Minister is talking about reducing the consumption tax rate only for food items. Even with that, there will be quite an amount which will be required. But we have already reduced gasoline tax, and we have secured the financial resources every time we have decided on spending. We have explained it to the IMF as well. Just last week, I was in Washington, D.C. to attend the G7 and like-minded countries meeting, and we had a bilateral meeting with Managing Director Madame Georgieva of the IMF. And she knows that every time Japan takes an action, we have paid careful attention to fiscal sustainability, and we have been mindful of ensuring fiscal sustainability. We know that public debt dependency has been coming down, and she gives credit to that, and she fully appreciates that. This year, the fiscal deficit to the GDP of Japan will be the lowest among G7 countries, which is not widely known. And it is within this framework that the Prime Minister is talking about eliminating wasteful tax exemptions.
The market's obviously still not confident about Japan's finances. We're seeing 30-year JGB yields higher than the bonds of the same tenure. Might you want to stabilize the bond market somewhat? Might you ask the BOJ to increase its scheduled bond purchases Wednesday morning just to bring that stability to the market?
Of course, we will work to restore the market confidence, and we have already been in communications with institutional investors. We have already been in communications with the BOJ. I wouldn't be attending this Davos meeting if there were something that we could officially announce.
So you're willing to take concrete steps to bring stability to the Japanese bond market?
I've been in the position of Ministry of Finance for 4 months now, and it might not be as much as you imagine, but I have taken concrete measures to bring stability to the market. What I can say is that we have done so, and I will continue to do so.
Don't worry. How are you assessing the risk of contagion? We have seen treasuries getting impacted. We have seen the Australian bond market getting impacted. Might we see what's been deemed as the bond market meltdown in Japan impacting the rest of the world?
The recent JGB auction went very successfully, and we have a well-thought-out future option of the JGBs, and we are confident the future upcoming auctions will be successful as well. I don't think it's right for me to talk about the potential impact.
Japanese Finance Minister Satsuki Katayama speaking with Bloomberg's Hasinda Amin in Davos. And we're also watching gyrations in South Korea's currency space. Bloomberg has learned that South Korea will hold off on fulfilling a pledge to invest as much as $20 billion in the U.S. this year, given the pressure on the Korean won. A source says that investment will have to wait until the current FX situation stabilizes. Seoul has pledged to invest a total of $350 billion in the U.S. as part of its trade deal, but it stoked growing concerns over the country's ability to finance the capital outlay. We have more ahead on the Asia trade. This is Bloomberg. Here are the top global headlines that we're following. U.S. Trade Representative Jamieson Greer says there may be another round of China trade talks ahead of President Trump's meeting with Xi Jinping in April. Greer suggested that discussions could move beyond highly sensitive issues and focus on basic goods and services. He spoke after Treasury Secretary Scott Bessent held an informal meeting in Davos with Chinese Vice Premier He Lifeng.
Multilateralism is the right way to keep the international order stable and promote humanity's development and progress. The rules must apply equally to everyone. A handful of countries should not enjoy privileges based on their strengths, and the world must not return to the law of the jungle where the strong bully the weak. Every country is entitled to defend its legitimate rights and interests.
Bloomberg's been told that the U.S. Justice Department has subpoenaed Minnesota Governor Tim Walz and other state officials to investigate whether they impeded federal immigration operations. Meanwhile, President Trump has said ICE agents sometimes make mistakes, even as he broadly defended his migrant crackdown. The president's comments came as polls suggest declining public support for his hardline approach.
They're going to make mistakes sometimes. ICE is going to be too rough with somebody, or, they're dealing with rough people. They're going to make a mistake. Sometimes it can happen. We feel.
Let's take a look at U.S. assets following on from these market concerns of Trump's ambitions towards Greenland and the extent in which any tariffs imposed on these allies could actually translate into a broader all-out trade war as we watch for whether Europe will retaliate in the extent in which it weaponizes assets, so to speak. And certainly we've been hearing seeing how U.S. treasuries on the long end in particular was sort of jolted following the Danish pension funds talk about exiting treasuries. Its CIO saying that the U.S. is basically not good credit. Meantime, we're hearing from the UBS chief, Sergio Ermotti, as well, saying that Europeans tempted to weaponize their holdings of U.S. government debt are making a dangerous bet that risks backfiring. Speaking to Bloomberg, Ermotti said diversifying away from the U.S. is impossible because it remains the strongest economy in the world.
Diversifying away from America is impossible. I think that in any major asset allocation, one could probably think about having an overweight or underweight, but diversifying away from the U.S. and also from the dollar is a quite dangerous bet. Things can change rapidly, and the U.S. is the strongest economy in the world. The one who has the highest level of innovation. Right now is a little bit bumpy, but I would say that I wouldn't really bet against the U.S.
There seems to be a difference between how the politicians and the policymakers talk about America right now and the backdrop for international relations and how a business person thinks of America, the economy and the opportunity. I've mentioned this stat a number of times already today about the survey that PwC put out. They surveyed 4,500 CEOs and the top destination for capital for investment, America, and it was up on last year. As a bank boss right now, a CEO who's thinking about expanding around the world, why is US still top of mind for you?
Well, because from our standpoint of view, we see two big levers. First of all, wealth creation, GDP growth, innovations, and also more idiosyncratic to UBS is that we see potential for us to become more present, increase our market share. So that's one place. On the other hand, we are also very big in Asia. I mean, we manage $1 trillion of assets there. We are growing very fast. The economy is growing. Half of the population in the world is living there and is creating new wealth. But in the Americas, it's a place for a financial institution, a wealth manager like UBS is a place to be.
UBS CEO Sergio Ermotti speaking to Bloomberg Jonathan Ferrer there in Switzerland, Davos. And of course, we continue to follow the Japanese markets as we're waiting for the market opens, with Nikkei futures now pointing to the downside of more than 1%. And remember, we have already seen 4 sessions of losses, the Japanese yen holding steady. But it's really about what's happening in the bond space after that massive sell-off that we saw in the previous session. Let's get the outlook with Garfield Reynolds, who leads our Markets Live Asia coverage. And Garf, it's been really interesting because it happened so slowly yesterday, right? And not necessarily any really cause any concrete reason why we're seeing this? We knew that the election here in Japan was coming up. We knew that there could be more government spending. So what's going on?
Well, I think a few things happened. One is that between the reduction in demand for the US dollar, or certainly the price of the US dollar, amid all of the Greenland situation, plus the efforts from Japanese and US officials to restrain the yen, the venue for expressing concern about the potential impact of Takaichi's policies should she win an increased mandate, that switched to the bond market, as the currency market wasn't really offering much traction. So that was part of it. Also, the sort of the concrete pledge for a sales tax reduction for food, which is the removal of a significant revenue-generating measure as part of her campaign pledge, that was on the radar. And for the bond market, and for others, in fact, the idea that this is a temporary tax cut, that's always a slippery slope. Most people are expecting that this temporary tax cut will become permanent. You also have the other part, the rival parties, talking about tax cuts as well. So we kind of had sell the yen on the rumors of the election, and then we got sell JGBs once it became clear that the election was coming and that it was likely to see the government and its competitors lean into fiscal laxity, as it were, for a bond market where the only way had been up for yields for some time. So you just didn't have a lot of people who were interested in buying JGBs in that environment, and especially, the 20-year auction, it went off okay. That's not a particularly popular bond tenor, and the immediate metrics were so-so, but plus we also there's this second round of non-competitive bidding that occurs for JGB auctions, where primary dealers can take up extra allocations at the price that was set at the auction, and they didn't as the day went on yesterday. So overall, the auction disappointed. The prospects for demand for long-end JGBs in the coming weeks are not great. So investors generally took a major step back, and you had this cascading sell-off that got rather alarming by the end of the day.
Garth, that's a very useful way to frame it. Thank you so much for your analysis as we watch how JGBs trade in the next hour. Garfield Reynolds leads our Markets Live coverage. Now let's take you to New Zealand as well, where we have breaking news. The Prime Minister, Christopher Luxon, has announced the date of the general election this year, November 7th. And this comes as the national MPs gathered for their first caucus meeting of the year in Christchurch. And this was pretty much a date that had been anticipated by pundits, given how this sets the New Zealand election for after the date of the US midterms. Of course, that could be a key indicator for how Trump's remaining 2 years in office could look like. So again, we have the date of the New Zealand election that will be November 7th. And that being said, because of how long we have on this runway, does not necessarily fire the starting gun on campaigning, so to speak. More ahead on the Asia trade. This is Bloomberg.
Google DeepMind says Chinese AI companies have not been able to innovate beyond the cutting edge of technology and remain behind the frontier AI of the leading Western labs. CEO Demis Hassabis spoke with us at the World Economic Forum in Davos.
It's been hard work, really hard work getting our technology and the models sort of back to state of the art. I think we did that with Gemini 3 especially, and Nanobun on our imaging software. And then I think we've also sort of adapted really to this new world of shipping very fast, kind of bringing a kind of startup energy to what we do.
Do you think people underestimated Google? or got something wrong?
Yes, maybe. I'm not sure. I mean, I think we always had the ingredients, to be at the forefront of this. Obviously, we've got the long history in it. I think, over the last decade, Google and Deepmind, between us, we've invented most of the breakthroughs that the modern AI industry relies on now. Obviously, transformers most famously, but AlphaGo, deep reinforcement learning, these things. And we have these incredible product surfaces, billions of user services that are natural fits for AI, actually, from search to email to Chrome. And but it's just getting all of that together and organized in the right way. And I think we've done that in the last couple of years. And there's still a lot more work to do, but I think we're starting to see the fruits of that.
A year ago, DeepSeek seemed cataclysmic for the West. Now, a year later, it's quiet. China seems to have been quieter.
Yes.
Has your opinion on competition from China changed?
Not really. I mean, I didn't think it was cataclysmic in the first place. I think it was a massive overreaction. In the West, it was impressive. And I think it shows that the Chinese are very capable, the leading companies. I think companies like ByteDance, actually, I would say, are the most capable. And they're maybe only 6 months behind, not 1 or 2 years behind the frontier. So I think that's what DeepSeek showed. Some of the claims were over-exaggerated about the amount of compute they used and being so minimal and so on, because they relied on some Western models and also fine-tuning on the outputs of some of the leading Western models. So it wasn't sort of de novo. And the other thing I think so far is not yet to be seen is, can China actually, the Chinese companies, innovate beyond the frontier themselves?
And we're bracing for the market opens in Japan and South Korea after that global sell-off and the Japanese bond market meltdown as well. We'll be back at the top of the hour. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens and bracing after that global market sell-off. The Sell America trade is back in force. Of course, those threats over tariffs, Avril, really not sitting well with investors. And the Japanese bond market meltdown not helping.
Yeah, whether this all dents the appetite for U.S. assets, as you say, the Sell America phrase making its rounds again. And we all saw how the yield curve bear steepen among treasuries. We'll be watching whether that extends. But it's interesting to see how in JGBs, maybe there can be some calm coming back to the markets today. Maybe not the same case for stocks, though, Shery.
I'm very afraid of guessing at the moment because it was such a chaotic session. I mean, traders were not even sure why we got this huge market meltdown here in Japan, especially given that we have seen the election date and the election speculation over more government spending already for a couple of weeks. Take a look at how the Nikkei is coming online. We had seen 4 sessions of losses for Japanese equities. We are continuing that streak and the Japanese yen holding at that 158 level. But as we mentioned, it's really been about the JGB space because those promises over that temporary sales tax cut on food, leading to more anxiety that this could be a Liz Truss moment here in Japan. Remember the 2022 vicious sell-off that we saw in the UK after that unfunded tax cut package, leading to the Prime Minister to resign. And we have seen, of course, those concerns around that tax cut here in Japan that could be worth around $32 billion per year. Still, the finance minister, though, defending the moves by the government. Take a listen to what she had to say.
Since October of last year, we have taken a very responsible approach to public finance, talking about responsible, sustainable, and proactive fiscal policies. We are not talking about expansionary fiscal policies, and this is demonstrated by some of the numbers that we see. So I asked the market participants to calm down.
Yeah, and JGB seemed to be rising a little bit early in the session, but we haven't yet even spoken about the Bank of Japan policy decision coming up later in the week. And take a look at how Korea is coming online as well, because it has seen an incredible rally this past month. We're now seeing a second session of losses after halting those 12 days of a rally. The Korean won continues to see weakness. Look at that, sliding towards that 17-year low. We were watching the benchmark yield in South Korea as well, because it had risen equivalent to that 2024 high as well. We are now hearing from sources that Korea will be delaying the $20 billion U.S. investment package this year, given the pressure on the South Korean currency that perhaps is helping the trade numbers, especially with exports. We're getting those numbers for the first 20 days of the month, rising 14.9% year-on-year. Imports also rising more than 4% year-on-year, but still a trade deficit of $626 million.
Shery, it's also interesting how the U.S. president might potentially react to the idea that Korea delays such an investment pledge. After all, this was a key point in sealing that trade deal. And as we look at these tariff developments with the Greenland ambitions on our minds, is really also watching the potential retaliatory action from European leaders. France has stood out amid all this, whether there is any weaponization of assets. Don't forget, Europe, they hold a lot of these U.S. assets as well. Taking a look at the moves in treasuries, we are seeing a bit of calm coming through, but don't forget, we did see those steep moves on the long end, particularly the 30 years in the past session. Futures also moving sideways. Let's bring in Mozamil Afzal, CIO at EFG International, for analysis on the outlook as well for the markets. Mozamil, great to have you in the studio with us. So we are seeing, based on the steep reaction just a day ago, maybe a bit of calm is coming back. What is your sense of where things go from here?
Look, I think one of the things we just can't deny is that the long end of the curve, certainly 30-year part of the curve, has steepened massively. So if you look across the bond markets, not just in Japan, but if you look across the US and Europe, I like to look at the 5 to 30-year part of the curve, just because it's very, very steep. Obviously, that shows inflationary forces, that shows economic growth, actually. So there are some kind of positives implied within those curves. The problem is when you get these extreme moves like we've seen in Japan, it just creates that fear, and obviously, ultimately, stocks are a valuation of the long end of the curve, if you think about long-duration assets. Yeah. So, as we were talking a little bit earlier, we haven't seen JGBs, 30-year JGBs at these levels in decades, right? So that is certainly a concern. But also, from an investor perspective, it's not a bad thing. It's starting to look a little bit more attractive.
But to your point about how it's really these jolts, right, that's catching attention, do you think Japanese authorities have the wherewithal, whether it's the MOF or the BOJ, to calm things down in the interim?
Of course, I think talking about that, how inflation is ultimately going to give me control. I think they'll have to continue with the short rate hikes, so I think that will continue, and that should ultimately kind of stabilize the situation. You've got to remember, Japan still has, unfortunately, a large demographic problem. So yields at these sort of levels are actually quite attractive for Japanese pension funds and large Japanese institutions, because those yields are particularly high. So I suspect that as we get closer to the election, they'll start to be a little bit more calm. The BOJ will probably come in. Maybe there's a bit of currency buying of the yen as well, just to stabilize things. But I suspect at some point there will be some calm, because you still got that demographic issue that, quite frankly, hasn't gone away.
At least the Widowmaker trade seems to be paying off, the short JGB trade that has sent now our colleagues saying that husbands have been brought back from the dead. Take a look at this terminal chart on the Bloomberg, because it's now become a rainmaker. But I mean, I guess, as you said, how long will this last? It's called Widowmaker for a reason. But the problem, I think, is also what happens when it spills over into the rest of the global bond space, as you mentioned. And when the moves are so accelerated, it's always the issue when it has to do with pace.
No, exactly. And I think if you see like a 4%, for example, 30-year yield, you then have to look from a Japanese investor perspective. Remember, they've been investing abroad to pick up those yields in the United States, in Europe, in emerging markets. But once you have your home market at 4%, say 30-year, you're starting to bring some of that money back home, because the relative attractiveness of your local market is there. And one important thing is Japanese JGBs in particular are bought by domestic institutions. they're not typically bought by foreigners, although foreigners will probably start to look at it, certainly when you look at the dollar-yen at 158 and 30-year at 4%, we're starting to see dynamics that we, as I mentioned a little bit earlier, we haven't seen in decades.
Mozamil, if I step back here and look at the markets and the different dynamics ongoing for a couple of years now, we're comparing what's happening here in Japan with a potential Liz Truss moment and what happened back in 2022 and this unchecked government spending scenario. We are talking about the Sell America trade and Secretary Bessent having to defend that countries will not be dumping treasuries as well. Is this a concern when you're looking at how much governments are spending across the world, and where do you go to hedge and find some safety?
No, absolutely. I think the safety trade is obviously, particularly important. At the moment, is really at the short end of most curves. And of course, as curves are steepened out, you'll probably start to see possibly towards the end of this year or next year, sort of duration extension starting to play a lot more important role in people's strategies. So that's the first thing, is that, curves are steepening out. As I said, steeper yield curves are usually signs of better economic growth prospects. But eventually they get too high, and of course they start to become attractive, and you see people moving along the curve. And quite frankly, most investors have been short dated for the last, since 2021 actually. So duration extension is certainly going to be a little bit more interesting going forward.
Where do Japanese equities, and for that matter North Asia equities, sit amid all these market ructions? Do we also just look past this?
No, exactly. And I think, as I said, the global economy, certainly in our view, is going to start to or continue to improve over the course of the next 6 to 12 months. We have a trough in interest rates probably this year across most continents, and then we'll start to see curves steepen out as they normally do. And investors, that's usually quite a good sign, because it's it's stimulatory in essence. So I think that the global economy continues to improve, and I think we need to also remember that Japan and Korea in particular are both very sensitive to global economic growth conditions, and so that steeper yield curve is actually quite good for them from a cyclical perspective, where of course flatter yield curves like we saw in 21, 22 and even 23 are not particularly good conditions for cyclical companies, particularly export companies.
Mozamil, great thing that you mentioned South Korea, because we are now seeing the downside in that market after 12 days of a rally. We are talking, of course, about the idiosyncratic issues and their trade deal and the pressure on the currency because of how much there could be in terms of capital outlays. But at the same time, more than half of the rally that we've seen in the Kospi in the past year has come from two companies, Samsung Electronics and SK Hynix. How much of an issue are these valuation concerns, not only in South Korea, but a lot of these tech-dependent economies in Northeast Asia?
No, absolutely. Valuation is probably the single largest concern. There's absolutely no doubt. But you are getting the fastest earnings growth from those same companies, right? So the challenge is finding that balance between valuation but high earnings growth. Now, the tricky part in all of this is you start to get earnings inflection. So you're not seeing those earnings revisions coming from analysts, as we're seeing from both SK Hynix and Samsung at the moment. Analysts are revising upwards their earnings. As soon as you start to see the inflection, that's when investors start to get a lot more concerned, to say, has the valuation outstripped those earnings growth numbers that we're seeing? And of course, those multiples look a lot more challenging in that type of environment.
Mozamil Afzal, really good to get your insights on a day like today. CIO at EFG International, as we continue to watch the fluctuations in the Asian markets, especially when it comes to JGBs. We are seeing a little bit more of calm, perhaps, should I dare say, in the JGB space. At least we are seeing the 40-year yield, 30-year yield all coming down a little bit, but still we're talking about around the highest levels on record. The 40-year rate still above that 4% level, and that's a level that has never been reached by any maturity here in Japan. And you can see Nikkei stocks also continuing to lose ground now for a fifth consecutive session, all to do with investor concerns about the Japanese government spending trajectory, especially with the election coming up on February 8th. Take a listen to what Japan's finance minister had to say, because she was calling for investors pressures to come down during her conversation at Davos. Take a listen.
I don't have any concerns about the absorption of JGBs going forward because we have a well-thought-out plan for JGB issuances. I believe the Ministry of Finance of Japan is perhaps the best Ministry of Finance in the world in terms of our close communication and careful communications with the market participants.
Investors obviously disagree with the perception that you hold right now. They say that JGBs are not the ones to buy at this point in time. There are huge concerns about your finances. How do you respond to that when they say that perhaps Japan's bond market is a canary in a coal mine?
I think those concerns are misplaced. We put a lot of importance on sustainability of our public finance. If you look at the draft budget for all this year, for the first time in 28 years, we will be achieving a primary balance surplus. If you look at our economic policies, through our economic policies, the plan is to expand the size of the Japanese economy. We have already seen an increase of tax revenue by 84 trillion yen, and we are to spend without additional borrowings. And as if you could look at our dependency on JGBs, the public debt dependency is at a 30-year low. As the Minister of Finance, I am not going to ignore the concerns in the market. The Prime Minister has been talking for the past couple days about an election to ask for the confidence of the public. She has talked about a possible plan for reducing the consumption tax rate. I know that is one of the reasons why the market has become rather nervous. But she has said that Japan is not going to depend on issuance of deficit-covering bonds. Since October of last year, we have taken a very responsible approach to public finance, talking about responsible, sustainable, and proactive fiscal policies. We are not taking expansionary fiscal policies. And this is demonstrated by some of the numbers that we see. So I ask the market participants to calm down.
Japanese Finance Minister Satsuki Katayama speaking with Bloomberg's host Linda Amin in Davos. Now, let's also talk about what we're seeing in South Korea. This is a day where the broad benchmark, or the Kospi, I should say, is underwater for another session. But look at the way in which Samsung Electronics, SK Hynix, which have been companies driving the rally this year, are performing. It really speaks to this divergence and perhaps the narrowness of the climb in the South Korean stocks. Also maybe gives you a sense of how on a day where industrial names are really getting hard hit and you're seeing these gains in the chip makers, that the chip strength appears to be that major surprise for markets today. More ahead on the Asia trade. This is Bloomberg. We're continuing to track the worsening crisis over Greenland, and as well, despite some calm in the market, the meltdown in JGBs in the past day, all that has been supporting haven demand. You're looking at gold at record highs, silver near all-time highs. Now, the U.S. president says he's confident the EU will continue to invest in the U.S., even if he imposes new tariffs in his quest to take control of Greenland.
I doubt it. Look, they need that agreement very badly with us. They really do. They fought very hard to get it. So I doubt that. But we'll see what happens. We have a lot of meetings scheduled on Greenland.
Meanwhile, the president's top economic advisors are in Davos, playing down the risk of U.S. military action in Greenland, even as the island's prime minister warns residents to prepare for a possible invasion. Let's bring in Bloomberg managing editor Jill Deeses. Jill, we were seeing this conflict or tension, I should say, simmering, and then now it's kind of come to a head. Does it all rest on the way in which the U.S. and European leaders engage with each other at Davos? Is there an off-ramp here?
Yeah, well, Avril, I think, first of all, it's not really difficult to see why President Donald Trump is so emboldened over what he sees as his ability to seize control of Greenland, because you just have to look at the last year, the first year of his return to the presidency, where he effectively brought the entire world to the table over tariffs, threatening all of these massive tariff increases on nations everywhere. And he was able to get a lot of them to agree to deals where they're still paying pretty significantly high premiums here. So I think that's that, in combination with obviously some of his other recent efforts, including in Venezuela, I think really emboldened the president here. Now, the ultimate question comes to how dramatically this may escalate. You've got Trump on the one hand, kind of flirting with the idea of a military invasion. I think despite the fact that does remain still the incredibly unlikely scenario, the fact that you've got the Prime Minister of Greenland kind of raising that prospect and submitting warnings to the island, I think is quite serious here. But on the other hand, you've got some of those economic advisors that have already made their way to Davos. Scott Bessent basically telling everybody to take a breath, and you've also got the trade representative Jameson Greer, who is kind of floating the idea that maybe this could unfold in the sense of some kind of an economic negotiation. I think that's where they're really paving the groundwork with things like Trump's tariff threat. Although when you've got Europe that's ultimately sitting there saying, should we actually unfold some kind of, retaliatory tariffs? That's something that they may discuss later this week, and that could ultimately happen, maybe February 7th if those Trump tariffs go into effect. I mean, it does suggest to you that there's a lot at play here, and something that, again, suggests a very serious escalation. But, obviously Trump thinks he can win here, and he thinks that, Europe is ultimately bluffing.
What economic solution would there be? Wasn't there already a trade truce sealed back in July? How are European leaders now reacting?
Yeah, and I mean, look, yes. So, yes, you look at some of the reaction over, how steady some of those trade relationships actually were. It does seem like, the general consensus there is that a lot of that ultimately holds. But I think really all you have to do is look at the last year that a lot of this has unfolded. I mean, yes, you've got, a lot of verbal and in some cases written trade truces, trade agreements. But, we have seen how the Trump administration, kind of treats a lot of these trade arrangements over the last year. I mean, we're talking like massive, multi-billion-dollar deals that, have been put together, in a matter of only like 3 to 6 months. I mean, we're in a brand new world here under Trump 2.0, where just a decade or so ago, when you talked about trade relationships, I mean, trade negotiations were things that unfolded over the course of, 5, 10, multiple years, really trying to button up all these deals. Trump seems to operate in this universe where, a lot of that can kind of change at the drop of a hat, no matter what he's ultimately negotiated. And you also have a lot of these deals, including, with places like China, for example, where he really is kind of bought into the idea of temporary trade truces, where something that is true for maybe, 6 months, 12 months might not be true after that. So I think, in Trump's world, he can kind of, continue to negotiate or continue to kind of change the goalposts and change the playing field here. I mean, again, obviously he found negotiating with tariffs last year enormously successful for him. So I don't think that it's a surprise that comes out as a point of leverage that he's using, or that he's threatening once again, because it seems like for Trump, that's his playbook and his mind is working right now.
Yeah, to your point about how quickly things can change, we are, of course, wondering as well how China is viewing all this, given how the U.S., Europe, the trade deal, it just kind of disintegrated in this manner. And we have U.S. and Chinese negotiators reportedly set to meet before April as well.
Yes, I think actually China is a really interesting situation, sort of standing aside from all of this. Certainly not a U.S. ally, and certainly doesn't have the same relationship that the U.S. has with Europe. But I think you look back over the last year, it's actually China that was the one that kind of stood up to a lot of the most severe threats that Trump in the Trump administration ultimately placed on escalating those tariffs. I mean, when we were seeing things being threatened north of 100, 150% or so, I think, at this point, China does have a lot of cards to play, particularly when it comes to a lot of those negotiations over rare earths, minerals and such. So that is part of their back pocket. Obviously, China does suffer from, a lot of domestic, uncertainties over their economy. Consumption is certainly, continues to be a really, really troublesome spot for China. But, they've certainly found inroads in with other nations, that have accepted Chinese exports. So I think economically, the world's second largest economy does have a lot more backing there. I think at this point, particularly in light of the meeting that Trump and Xi Jinping had at the end of last year, those continued overtures that Trump may meet with Xi in April in China later this year, that does continue sort of being an open inroad. But again, I think, we were talking about this about a year ago as well. The relationship between the U.S. and China versus this really adversarial relationship between the U.S. and Europe is really, really remarkable to see.
Jill DC, it's good to have you with us. Bloomberg managing editor with the latest on all things tariffs and President Trump, of course. As we're now watching European futures coming online, we had seen the stock 600, for example, in the previous session lose ground, not surprisingly, given, of course, the threats of more tariffs coming from the president. And you can see the downside when it comes to DAX futures as well. This all after European stocks reached record highs just last week. We have seen that uncertainty just scale in the gilts and boons. Markets selling off, despite the fact that Germany's reputation is one for fiscal discipline. And you can see euro holding steady at that 117 level. Do watch out for the Swiss franc, which has been outperforming given the safe haven moves in recent days. More ahead. This is Bloomberg. Take a look at some of the big movers in the Japanese session, because we are seeing some of those banks and exporters, industrials leading the declines. And we have seen, of course, the yields in the JGB space coming down a little bit from those record highs. But of course, the Japanese banks also very vulnerable and susceptible to rising yield losses on their large bond holdings as well. And we continue to watch the Japanese yen also holding at that 158 level at the moment. This is Bloomberg. We're seeing a little bit more stability in the JGB space with yields coming down from record highs, but the 40-year rate still above that 4% level, at levels that we haven't seen since its debut in 2007. The 10-year yield also above that 230 level, all to do with concerns about that temporary sales tax cut on food promised by Prime Minister Takaichi after the snap election on February 8th that could cost around $32 billion per year. Bloomberg Economics, though, thinks that this JGB meltdown could prove to be temporary. Authorities could cut ultra-long issuance. They could step in with temporary purchases. Speaking to us in Davos, in fact, Japan's Finance Minister Satsuki Katayama defended the government's fiscal policies as responsible and sustainable.
I don't have any concerns about the absorption of JGBs going forward because we have a well-thought-out plan for JGB issuances. I believe the Ministry of Finance of Japan is perhaps the best Ministry of Finance in the world in terms of our close communication and careful communications with the market participants.
Investors obviously disagree with the perception that you hold right now. They say that JGBs are not the ones to buy at this point in time. There are huge concerns about your finances. How do you respond to that when they say that perhaps Japan's bond market is a canary in a coal mine?
I think those concerns are misplaced. We put a lot of importance on sustainability of our public finance. If you look at the draft budget for all this year, for the first time in 28 years, we will be achieving a primary balance surplus. If you look at our economic policies, the plan is to expand the size of the Japanese economy. We have already seen an increase of tax revenue by 84 trillion yen, and we are to spend without additional borrowings. And as if you could look at our dependency on JGBs, the public debt dependency is at a 30-year low. As the Minister of Finance, I am not going to ignore the concerns in the market. The Prime Minister has been talking for the past couple days about an election to ask for the confidence of the public. She has talked about a possible plan for reducing the consumption tax rate. I know that is one of the reasons why the market has become rather nervous. But she has said that Japan is not going to depend on issuance of deficit-covering bonds. Since October of last year, we have taken a very responsible approach to public finance, talking about responsible, sustainable, and proactive fiscal policies. We are not taking expansionary fiscal policies. And this is demonstrated by some of the numbers that we see. So I asked the market participants to calm down.
What concrete steps will you take to fund all the spending plans? There have already been massive, significant stimulus, and now the Prime Minister has said she's cutting the consumption tax, which amounts to 8%. That leaves a huge hole, I suppose, in revenue.
The Prime Minister is talking about reducing the consumption tax rate only for food items. Even with that, there will be quite an amount which will be required. But we have already reduced gasoline tax, and we have secured the financial resources every time we have decided on spending. We have explained it to the IMF as well. Just last week, I was in Washington, D.C. to attend the G7 and like-minded countries meeting, and we had a bilateral meeting with Managing Director Madame Georgieva of the IMF. And she knows that every time Japan takes an action, we have paid careful attention to fiscal sustainability, and we have been mindful of ensuring fiscal sustainability. We know that public debt dependency has been coming down, and she gives credit to that, and she fully appreciates that. This year, the fiscal deficit to the GDP of Japan will be the lowest among G7 countries, which is not widely known. And it is within this framework that the Prime Minister is talking about eliminating wasteful tax exemptions.
The market's obviously still not confident about Japan's finances. We're seeing 30-year JGB yields higher than the bonds of the same tenure. Might you want to stabilize the bond market somewhat? Might you ask the BOJ to increase its scheduled bond purchases Wednesday morning just to bring that stability to the market?
Of course, we will work to restore the market confidence, and we have already been in communications with institutional investors. We have already been in communications with the BOJ. I wouldn't be attending this Davos meeting if there were something that we could officially announce.
So you're willing to take concrete steps to bring stability to the Japanese bond market?
I've been in the position of Ministry of Finance for 4 months now, and it might not be as much as you imagine, but I have taken concrete measures to bring stability to the market. What I can say is that we have done so, and I will continue to do so.
Don't worry. How are you assessing the risk of contagion? We have seen treasuries getting impacted. We have seen the Australian bond market getting impacted. Might we see what's been deemed as the bond market meltdown in Japan impacting the rest of the world?
The recent JGB auction went very successfully, and we have a well-thought-out future option of the JGBs, and we are confident the future upcoming auctions will be successful as well. I don't think it's right for me to talk about the potential impact.
Japanese Finance Minister Satsuki Katayama speaking with Bloomberg's Has Linda Armin in Davos. For more on the JGB markets, our Chief Asia FX and Rates correspondent Ruth Carson joins us now. So Ruth, it was a pretty chaotic 24 hours. Maybe there's a bit of a calm or semblance of that returning. Is that your read into the situation as well?
Well, we heard Katayama's comments literally a few seconds ago. Is there calm right now? Things have calmed down a little. But when we just zoom out a little, even the past 24 hours, we had a Treasury's fire sale arguably on Liberation Day. Perhaps yesterday was Japan's. And in that sense, we are still seeing embers about. The fire might be put out at the moment, but listen, just in terms of talking to traders in the market, everyone is still on edge. 27 basis point move higher in longer dated debt is nothing to be sniffed at. This isn't an emerging market. This is the world's third largest bond market, and it is closely watched, and contagion risk is on everyone's minds.
And we already saw some of that happen overnight, right? I mean, we're talking about treasuries, gilts, even bonds selling off.
Absolutely. And this is a very interesting phenomenon because for years we saw JGB yields being anchored due to ultra low interest rates. But all this is actually changing now. So that contagion risk, which I mentioned earlier, is top of mind for all the macro investors out there. Everyone is waiting. Everyone is watching. And we saw the move pick up. It was a quiet day to start with. Then a confluence of factors happened. And then we suddenly saw JGB yields just soaring. And suddenly, within an hour, within minutes, we actually saw pressure starting to pile on longer dated US debt. Now, is this going to be an isolated incident? Not according to the people that I'm speaking with in markets.
What else are they saying? I mean, we had that 20-year yesterday. Katayama says it was a good one. I don't know if you share that view, but we also have a 40-year auction that's coming up as well. I mean, what sort of demand can we realistically be anticipating there?
Well, we're only 21, 22 days into the new year, and everyone is already passing through that calendar. What is up next? Yesterday's auction did face some lackluster demands. There were some lackluster statistics there. Let's be clear about things according to bond markets, and bond markets have signaled that. Now, is that pressure going to persist? Likely, yes. There is still that underlying tension in markets. Is the BOJ hiking interest rates as quickly as it should? And the verdict at the moment is no. And as long as that verdict is there, the yen is still going to stay weak. And yes, we will potentially, most likely, see ongoing tensions ahead.
Are we expecting fireworks then on Friday with the BOJ decision?
So it's very interesting. As we saw JGB yields soaring, skyrocketing yesterday, it was certainly a topic of conversation, on among trading desks. Will the BOJ bring forward its rate hike? It's certainly being debated. Markets are sort of tussling on that front when it comes to pricing it in. But yes, absolutely. Investors will be passing every single word that comes out of the BOJ governor's mouth on where rates go from here, because it will impact JGBs, it will impact the yen, and it will impact the world.
Yeah, talk to us a bit more about this sort of interesting dynamic, right? You got high yields and then you have the yen weakening. What is the signal to macro investors?
It's actually quite counterintuitive when you think about it. Usually when yields go higher, currencies can move in tandem, so they go stronger. And what did the yen do yesterday? It weakened. So again, in a way, the yen sort of sits at the nexus of investor tensions. Why is the yen trading at multi-year lows and near intervention territory when yields have actually saw 27 basis points? It's a strong signal that there is a bit of a loss of confidence here by macro investors towards holding Japanese assets. But that doesn't mean there's no trading opportunity. There's plenty of ways to make money here, particularly for the macro funds out there.
All right, Ruth, thanks very much. Our Bloomberg Chief FX and Rates Asia correspondent, Ruth Carson. Now, since we're talking FX, let's take a look at how other EM currencies are faring, given the slide we've been seeing in the Korean won. This is a phenomenon we've been pretty much seeing for the past 6 months, and against the backdrop of its investment pledges from Korea into the US. Sources now telling Bloomberg that Korea is set to delay that $20 billion investment pledge given the currency pressure, and that has helped to cap some of the declines in the Korean won, tracking the Indonesian rupiah as well, given its record lows just a day ago. This was even superseding what we saw in April, which was already the weakest since the Asian financial crisis, and the latest bout of selling on the rupiah sort of sparked by the president's move to nominate his nephew for deputy governor at Bank Indonesia. Of course, we also have a decision due from BI later today. More ahead on the Asia trade. This is Bloomberg. Let's take a look at how Greater China futures are faring as we count down to the markets open in the region. And of course, just a day ago, the machinations, gyrations surrounding Greenland, the Japan bond market sell-off, that played out in markets. It looks like we could see another down day based on what futures are telling us. Perhaps a clearer indication is where the yen has been guided by the PBOC. And amid all this, China seems to be trying to again portray itself as an advocate of free trade and multilateralism as U.S. allies grapple with fresh tariff threats from the Trump administration. Vice Premier He Lifeng has been making that case in Davos.
Multilateralism is the right way to keep the international order stable and promote humanity's development and progress. The rules must apply equally to everyone. A handful of countries should not enjoy privileges based on their strengths, and the world must not return to the law of the jungle where the strong bully the weak. Every country is entitled to defend its legitimate rights and interests.
For more, let's bring in our chief North Asia correspondent, Stephen Engel. So, Steve, China here on the world stage, portraying itself perhaps as a more reliable partner, as a global leader. How convincing has all this been?
Well, of course, this was a expected narrative coming from China, and they're rolling out similar narratives that they've used in the past 9-10 months or so, since, of course, the barrage of tariffs from the United States that led to that trade war, and then a truce right now. But again, they are appealing to the crowd in Davos, world leaders and world business leaders, to say essentially that China is going to allow greater access for foreign companies as they open up the consumer economy in China. He also tried to allay the fears in that room and around the world of the deluge of Chinese exports. Keep in mind, China has kept its economy humming based on the back, I should say, of exports. They had $1.2 trillion trade surplus in 2025, a record high. So he allayed those fears, saying they're going to build up more opportunities for foreign companies in China. And again, he did sort of talk again about that law of the jungle and some of the tactics. He didn't mention the United States, but it was clearly a reference to the trade policies of the United States. He says, we never seek a trade surplus. On top of being the world's factory, He Lifeng says, we hope to be the world's market too. So he's the man at the front of the trade negotiations with the United States. He's the economic czar of Xi Jinping. He is vice premier. So he carries a lot of clout, and he has garnered a lot of attention on the world stage as the lead negotiator in those several rounds of trade negotiations with the United States. I might add as well that Scott Bessent, the U.S. Treasury Secretary, has met with He Lifeng, and essentially Bessent says China has made good on its soybean purchases. In fact, its pledges, I should say, to buy U.S. soybeans, and says there could even buy more of those. And he says on rare earth magnets have flowed to the United States as expected. So good news on that front, to the point where even Jameson Greer, the U.S. trade representative, says he'd like to see perhaps another round of trade talks with China ahead of that planned trip to China by Donald Trump, slated for some time in April. And he also says, Jameson Greer says he'd like to see the two sides sort of move beyond the sticking points that they really hammered out over the last 9 months or so, and that being, national security issues, chips, export controls. And he says basic goods and services need to be discussed. Because again, guys, and Avril, the key for this, the key takeaway essentially from this visit to China has to have deliverables. So I think they're going to bring, lower hanging fruit to bear to have those deliverables for Trump and Xi to make it a successful summit, if it does indeed happen.
And Steve, to your earlier point of keeping the Chinese economy humming, it looks like authorities there are rolling out some incentives to boost consumption. What do we know?
Yeah, I think, obviously, going into 2026 here with the domestic economy sputtering, demand sputtering, the housing market is still in crisis. What are going to be the policies to help spur the number one priority? The number one stated economic priority for top leadership in China for 2026 is boosting domestic demand, boosting consumption. But the big question is, how are they going to do it? So what we're hearing is the Ministry of Finance announcing a slew of incentives to boost borrowing by small to medium-sized enterprises in the private sector, which the finance ministry says will boost their investments and their profits and therefore stimulate the economy and hopefully stimulate consumption. They've included a 500 billion yuan, that's $72 billion US dollar loan guarantee facility that will last 2 years with an annual interest subsidy of 1.5 percentage points. And again, they're trying to get the private, smaller to medium-sized enterprises humming again, get profits going, because there's been a race to the bottom, price wars across many sectors that is not doing, much service to boost consumption. People are not going to be catching a falling knife as prices have been, falling. We've had deflation at the factory gate last now for more than 3 years. They want to end that with their anti-involution campaign. We'll have to see, though, if there's going to be more policies like this one coming out to boost consumption ahead of the National People's Congress in the first week of March.
Certainly, that's what market watchers are also anticipating or hoping for, at least. Steve, thank you. We'll leave it there for today. Always good to chat. Bloomberg Chief North Asia correspondent Stephen Engel. Now, Hong Kong's financial secretary says the city will need to issue bonds to finance a new development known as the Northern Metropolis, even as the budget returns to surplus. Speaking to us in Davos, Paul Chan also said he's optimistic about renewed IPO momentum in the city's stock market.
Well, people are looking safe havens to park their funds and at the same time giving them good returns. They are looking for policy consistency and predictability. And in that sense, Hong Kong offers excellent alternative for them.
Of course, you're looking for fiscal surplus in 2026, quite ambitious, some say. Mm-hmm. But you remain confident. Why is that?
Well, 25-26, meaning year-end 31st March, operating account definitely a surplus. But, our account composed of operating account and capital accounts. Land revenue still needs time to go back to previous level. But we do need to expedite the investment in Northern Metropolis. So overall speaking, we still need to issue some bonds to finance the investments in Northern Metropolis. But going forward, I'm pretty confident because on the operating account, we're still registering services with our fiscal consolidation policies. In the past 2 years, we control expenditure growth and grow a little bit of our revenue source. And for the Northern Metropolis, we are also experimenting different options. Say, for example, inviting investors or technology companies. They come, we just give them a parcel of land of huge size. They can do the infrastructure, they can bring the ecosystem over. And in that sense, expedite the development process. And on the other hand, cut down the government's commitment in terms of infrastructure provision.
You talk about plans for the Northern Metropolis, because that is a priority for China as well. I'm just wondering, is there reason to spend big on the Northern Metropolis when your financial conditions are still stretched at this stage?
We see this as investment. So we invest upfront to grow the ecosystem. When the companies come, they bring their ecosystem over. In future years, they will pay me tax. So we invest upfront and get the return in later years. In the meantime, the cash flow differences, we use bonds to finance a bit of it.
Hong Kong Financial Secretary Paul Chan speaking with Bloomberg's Hasinda Amin in Davos. We have more ahead. This is Bloomberg. We're seeing broad downside across equities in Asia, with the Nikkei falling for a fifth consecutive session. Even the Korean market is down for a second day. What's interesting, though, is that the broad downside, though, is not being really felt in the tech space. We're seeing a little bit of upside and support in the semiconductor space, although the downside is being led, not surprisingly, by financials here in Japan. Of course, we are talking about those huge JGB losses that we saw in the previous session, Avril. Although today, perhaps, we're seeing a little bit of a return of calm with yields falling from record highs.
Yeah, Shery, it's interesting how we are seeing these gains in JGBs, or rebound, should I say, and some interesting perspective that's come through from our colleagues at Bloomberg Economics, including how when it comes to the MOF, the BOJ, it's not so much about whether they can handle all this, but perhaps more about the thin liquidity conditions on the ultra long end of the market. And then you have this note from SMBC Nikko Securities. They talk about how were the BOJ to increase some of these JGB purchases, it could reinforce the perception that the BOJ is subordinate to fiscal policy. So maybe don't expect so much of the JGB buying as we watch for the continued moves in the markets. That's it from the Asia Trade. This is Bloomberg.